Okay, so in this practice problem, we are going to look at the interaction of the ADAS model and our money market, which helps us to see a really clear picture of how monetary policy actually works. And I like this problem for two reasons. First of all, it's based on actual AP released questions, both multiple choice and free response. And additionally, it helps us to kind of reverse engineer monetary policy and think about what the Fed might be trying to do at a given time and then how they come to those choices. So first instruction, draw an ADAS model in long-run equilibrium. Our ADAS model puts price level versus real GDP. It has an upward sloping SRAS curve in the short run and a downward sloping aggregate demand curve. And these two are intersecting at PLE and at Y. So to make this a long-run equilibrium, we want to make sure we come through and drop in our long-run supply curve so that that output level at real GDP in the short run is YP or Y potential for long-run output at any given moment. In letter B, assume a tax cut is passed to stimulate the economy base beyond full employment. Demonstrate the effect of this on the ADAS model and show those changes on real GDP and price level. So we can jump in and say that a tax cut will lead to an increase in consumer and investment spending, and therefore an increase in aggregate demand. And we can come over and shift our aggregate demand curve to the right. And this rightward shift in aggregate demand will put us at Y2 and PL2. So we can see that real GDP has increased and price level has increased as well. Part C, what change to interest rates would appropriately return the economy to its previous real GDP levels? And this is where we begin to think about monetary policy and what the Fed might be doing to counteract this tax cut and counteract the increasing inflation and increasing GDP. Or really, the Fed is probably looking at this increase in demand and trying to counteract that. So if the Fed wants to bring demand aggregate down or bring aggregate demand back down, they can decrease aggregate demand by increasing real interest rates, because increasing real interest rates will decrease spending by consumers and businesses who will view spending as more expensive at given interest rates, and that, of course, will decrease aggregate demand. So if the Fed wanted to counteract aggregate demand increases, they would do so by raising interest rates in this economy. And part D, explain the appropriate monetary policies that could create the interest rate change above. So what we want to do is increase interest rates. So let's build our money market to help us look at this first. Our money market uses the nominal interest rate on the vertical axis and the quantity of money on the horizontal axis. We have a downward sloping demand curve and a vertical money supply curve. So if we want to increase interest rates, and we're talking about monetary policy, which relates to the money supply, then to move this rate from RE up, we need to move this money supply to the left, which will push our rate up to R2. So we need to decrease our money supply. In order to increase interest rates, the Fed or the central bank must decrease the money supply. And now the question becomes, what policies does the Fed have in its toolbox that can allow it to decrease the money supply? And the Fed has three major policies they can use. The first is that they can sell bonds. This is what we call an open market operation, and the selling of bonds leads to a smaller money supply. That's your kind of mnemonic device. Sell bonds, small money supply. The second is they could increase the reserve ratio, requiring banks to hold more in reserves. means banks can loan less, so the money supply comes down, or they could increase the discount rate. And the discount rate, again, is the rate that the Fed offers banks when banks need to borrow money from the Fed. By increasing the discount rate, the Fed is in fact kind of punishing these banks and encouraging them to hold more supplies and loan less. All three of these policies would decrease the money supply, and then as we look here, decreasing the money supply would increase our interest rate, and increasing our interest rate can drive down aggregate demand. Most of the time when we talk and think about monetary policy, we move this direction, kind of from D back to part A. Monetary policy, change on money supply, interest rates to aggregate demand. Here, of course, we've just worked that in reverse. If we want to raise interest rates, or rather, if we want to lower demand, we need to raise interest rates. If we want to raise interest rates, we need to decrease the money supply. And if we want to decrease the money supply, these are three options we have available. Remember that ultimately, with all of these pieces, you need to be able to move between interest rates, demand curves, money supply curves, monetary policies, and Fed policies in general, and see how all of these interact at any given time.